Hello, everyone. Welcome back to the Liquidity Narrative Classroom. Today is another day for us to learn something very interesting. Yes, we've been able in our previous classes, we've studied about smart money concept, what they really are, and then we've talked about why retail traders loses money. We've also gone through the real what liquidity really is. Yes, we've also studied about the difference between consolidation in the market and displacement, understanding them, and even market structure, how to read market structure. Remember, if you haven't gone through any of those videos that I've listed and so many other ones, you can see them in the channel. Of a certainty, these videos will help you to understand better whether you are a new trader or trying to prove your trading, a beginner, or you've been doing well, but you're not making much profit. Understanding these basics will be of guide. Remember, there are a lot of materials out there that you can lay your hands on, and some of them has been teaching us the wrong way. So that's the reason, and that will help or contributes to the industry, our industry of trading, to study the right way. That's the reason for another video in this area, because there are 1,000,001 people out there who have done a lot of videos to help. Maybe that's the way they know. But this is the right way for you to learn and understand. Trying to, I'm doing this because I would have loved somebody to teach me hand to hand, without going through a lot in understanding them, but making it simple. So that's the reason for this video, putting them together in the right way, because somebody was able to give me back. So I'm giving back to the industry. So that having been said, today we are going to be looking at something I've been able to say. We've done a lot of studies and go through them. They are like building blocks, one block at a time, to make a structure. So we are putting them together today, putting all those lessons together. Um, because if you know only liquidity is not enough, if you know only market structure is not enough, and the things we've said before, they are just not enough. That's the reality. So the question is, which direction should you actually trade? The question, most times we are looking for which direction. Just give me the direction. Maybe I'll be able to know exactly what to do. That reminds me, there was a story that I heard about people trying to give, like, we hear 5 keys to success, 10 keys to become the best trader, all those keys. And someone was apparently said, I've been studying a lot of keys to become successful, for breakthrough, for all this. The person then said, I don't want the keys anymore. Just show me where the door is. Then I'll be able to get through the door and get those prosperity. So that's just it. Most times we are like, which direction should we actually trade? So the answer begins with understanding the higher time frame bias. Yeah. So today's lesson is one of those biggest turning points in your trading journey. Yes. So what our objective in today's class on Liquidity Narrative Classroom? So we are going to be looking at what higher time frame really is. You might know it already, but then we just want to do it for the sake of everybody. We're looking at what the lower time frame is, what's bias, what it really means. So why the higher time frame controls the lower time frame, and also how professionals perform their top-down analysis, why trading against the higher time frame bias often lead to losses. So these are the things we'll be covering. The objective of what, remember, I have to say this chart we are using is just for the sake of learning. And whatever I'm going to say does not really implies that the chart is an uptrend or downtrend. What we are just using or looking at this chart is for the purpose of learning and to get example, like having a real chart, and because the class demand a real chart view. So this is not like saying, because we'll say maybe was the trend uptrend or downtrend. This is not like saying this is a continuation of uptrend or that the trend is changing. Everything we're going to be using this chart for, we purposely for this class. Thank you for understanding. So that having been said, let's start from the beginning. What is a time frame? What is a time frame? That's it. What do you understand when somebody said time frame in trading? I know you might have known it as a good trader, but then for the sake of those who are learning or get confused about that, it's simply when we talk about time frame, we are simply saying like it simply shows how much time each candle represents. Like as you're watching this particular chart now, this is a weekly time frame. So each of these candle takes like a week to complete, to form this candle. Each of them, every one of them takes 1 week. Like the starting of the market Sunday to Friday, the closing of the market. This is each candle represents a week. So if we drop to the daily time frame, the same way when we say daily time frame, it means that every candle you're seeing, be it bearish or bullish, no matter how little it takes, take a whole day, 24 hours to complete its forming, no matter how little, how big, how huge in the daily time frame. The same way you go through every time, so long as there is a time tag on it, the 4H, it takes 4 hours for these candles to form. It represents a time frame, completion of a particular candle. So we said every of them, it simply shows how much time each candle represents, how much time. It's just like when you're taking a journey, how time frame it will take you to cover that journey. Some people take flights. You can say flying, it will take like maybe 4 hours to the journey. If you're driving, it might take like 24 hours for you to do the driving. If maybe you are using the ship, you know how many hours. So that's the time frame depending on each particular type of transportation you are using. So in the chart too, each time frame represents how long it takes for the candle to finish performing its duty or form. So that's it. Like we've explained, from the 1 minute to the 1 hedge to the 1 month, each of them represent the time it takes. I hope that's just simple and the easiest way to explain it. So that's why the market is exactly the same way, just like we said, the 1 week takes a week. Each candle represents itself. The market is exactly the same, whether you're looking at it from the 1 minute, you're looking at it from the 2, 3, 4, 5, 10, 1 hour, 1 hedge, 1 month. The only thing that is different is your view. Like as we are looking at this particular chart, which is a 1 week chart, we can maybe see the view that things might be going up or it might be going down. But if you drop to maybe a lower time frame, the view might change maybe to something. Let's drop to the 15-minute lower time frame. So this is us on a lower time frame. So the same charts we've seen that have been going up, up, up. You can see what is happening here. At some point, it was going down. So the view changes. It's just where you are viewing from that gives you a different change. Let's give another example. Imagine that you are taking a road trip and you decided to check out your route using the Google map. Right. So, like the Google map, when you zoom in, it gives you a larger view. You're seeing a lot of, but very tiny, right? But when you zoom out, you are seeing maybe a particular section of that direction in the Google, depending on how you want to see it. If you want to see maybe just for a moment where you're looking at, that's it, you're zooming out, the moment you're looking just within, that's it. But if you want to see the larger Google map, you have to zoom in. The same way, if we go to the higher time frame, like the 1 week and the 1 month daily, the 4H, like zooming in to see the larger, how what the market is doing. This is it. We see the whole stuff of the market, the whole story of the market. So, but when we drop to a lower time frame, maybe our focus is on this particular level we mapped out, or a particular this level. Let's take for instance on this level. We want to see what exactly is happening here. So this is it. This is our map. We want to see we drop to a lower time frame to see exactly. You can see this. we've been able to zoom out on that particular level to see the reaction of the market in that level. All these things are just the small portion that we mapped out on that level. So you can see this is exactly what is happening in the lower time frame. It's giving us a present hour view of what is happening from the zoom in from the larger or the higher time frame. This is it. So it does not change. Your road does not change. What change is the perspective you are seeing it. I hope that makes sense to you. Yeah, it does. I know it does. So that's just what we are saying. We take this out again. So this is it. Oh, so we've been able to explain what higher time frame is. We've been able to explain what lower time frame. So now is better. Let's understand it. The higher time frame answer one question. The higher time frame, like we've said, the monthly, the weekly, the daily, the 4H, depending on the kind of trader you are, answered one question. It answered a particular question. Answer the question, where does the market wants to go to? You get it. Answer the question where we ask the question, where does the market wants to go to? So we are simply looking at the higher time frame to know, is the market likely to go up? Is the market likely to go down? So before you even take a trade, that's the first thing you should ask yourself. That's the first thing the professionals look into. They think about. They are not thinking about entry. The first thing they study is the bigger picture, which is the higher time frame. So you open your chart on the weekly time frame, you start to ask yourself, where is the market likely to go to? What type of market is this? Is it likely to go higher? Is it likely to go lower? Then we start asking on the lower time frame. The question now comes back, which when we are looking at maybe the 1H to 1 minute time frame, the lower time frame answered a different question, or answer has a different answer that says, instead of asking where is price going to on the lower time frame, then we ask, how can I enter the move safely? One is looking for where it's going to direction. One is like a directional question. The other one is like, how will I be part of this direction? So that's it. Notice the difference. The higher time frame decide direction. Are we going up higher? Are we coming down lower? While the lower time frame help with execution. So that's it. Let's take for instance in this particular, because the reason for the chart is to make it interactable and more educative. Let's take for instance in this particular chart, we've seen this, that from here that the market has been going higher, has been an uptrend. Does not mean that every week we end up high, but we have a more probability of the likelihood the markets making higher high, because we are in an uptrend in this particular chart that we are looking at, or this particular area we are looking at. Let's take for instance this level. So we've notified this level and said, okay, this market is an uptrend. So we move to the daily time frame. We've gotten a direction in the daily, in a weekly time frame. So let's focus just here on our daily time frame, because we know that the market, we've gotten a direction that the market is an uptrend. So every day that the market gets down, it's given an opportunity for us to be part of this trend, is part of the uptrend that we've identified, and we're looking for opportunity. We'll have more probability, a higher probability if we buy than we sell. Does not mean that every day or every week is going to be a buy or a sell day. So that's it. In our lower time frame, we are looking at how do we be part of this? How can we join and be part of this safe journey to the upside? It helps us in our execution. That's just it. So that brings us to the next area objective we are looking at, which is bias. We are looking at what's bias. When you said what's your bias in the market, the bias is simply means your directional expectation. Like we said, the higher time frame gives us direction. So if my bias is a bullish bias, meaning that I'm looking more to be buying in the market than selling. Does it mean there are not days where the markets or weeks will go down? No. It's just that I decided in my trading to follow the higher time frame direction. So my bias becomes what? Bullish and not bearish. So if the market is also a downtrend that we've established from the higher time frame, maybe using the weekly or the down or the daily, let's take for instance, in this particular level, I'm saying, okay, I'm looking more for a sell because I'm trading from a lower time frame. I'm looking for a sell. So my bias in this particular instance, this like 1, 2, 3. So this particular week is like a bearish trade for me. So I've gotten a bias. I'm saying I'm bearish this week. I'm looking for the reason to sell the markets. So I've gotten a bias of selling, which is bearish. So that has answered the question. What is your directional expectation? Do I expect price to move higher or do I expect price to move lower? That expectation becomes what? My bias. As simple as that. I've gotten a bias. The next thing is let's imagine it this way. You are planning a road trip. You want to take a journey, just like we said. You are driving from one particular location to another location. You are driving from here to here. Already you know your direction. You know, okay, I'm going to a particular place. I know I'm going bearish or I know I'm going bullish. I know where my direction, I know where I'm going. My destination is bullish or bearish. So you've already decided where destination is. You don't suddenly start driving towards maybe the ocean, depending on where you're going, because your journey might have an ocean demarcation about it. You don't just maybe start driving towards the ocean because the road looks nice or shorter. No. So you follow the route that leads you to your destination. You might choose to fly, you might choose to use the boat, you might choose to drive. But you follow the route that leads to your destination. You already know I'm going in for bullish. So I'm following the route that leads to buying, not the route that leads to selling. Trading works exactly the same way. The higher time frame gives you the direction, the lower time frame helps you choose the safest route to go through it. I hope that makes sense. It gives you the safest road or the safest way to go through it. So the same way the professionals, what they do every day is to perform what we call the top-down analysis. They are looking at it from the beginning. Like we said, everything is revolving, starting from the higher time frame, the weekly time frame, then we go through the daily time frame, and then the lower time frame for execution. The same way the professional, they also do a top-down analysis every day or every morning or every week. They're asking themselves, the question number one is like, what is the market? What is the weekly market structure? Now, remember I didn't say the overall structure. I'm looking at the week. So looking at it for this, we've already know that this particular market is an option overall. But each week, market is always seeking for something. What is the week? Like what we do in liquidity narrative analysis. We are looking at each week. We are not looking at the overall most times. So we mapped out between a range that we are looking at. What is the market seeking? So for a particular week, market might be bullish, it might be a bearish, it might be a ranging market. Just like here, we can see a whole lot of couple of weeks has been ranging, going sideways, no upward, no downward. So the question too, when you define exactly what you're looking for, is it going to be bearish? Is it going to be bullish or ranging? The next question they ask themselves is, what is the daily narrative? So we've established maybe like this is going to be a bearish or a bullish. When you move to your daily time frame, we are looking at the narrative. What story is the daily time frame telling us? You know the daily time frame. Most times your drawn liquidity is mostly fine on the daily time frame. Yes, it follows first before it can get to the weekly, before it can get to the monthly. So now the question is, what is the daily narrative? That's what you're looking for. And the next thing you're asking yourself is, where is the liquidity? And the next thing is, where is today's draw on liquidity? So the market is seeking for something. All these things, if you can be able to get all those questions, the answer to them, it has given you the whole picture of what to do in the market. Then the next question is, has the higher time frame given me a clear bias? Yes, I've gotten a bias. Like we said, we are bullish in the higher time frame. So only after you've answered that questions, then you move to the lower time frame to start looking for the right place for execution to be part of this. Yeah, let's do this. Let's do a practical one. Let's practicalize what we have said here, like we've been able to say here. Watch this place, we've mapped out this area, we've identified that the weekly is a bullish scenario. So we are looking for the reason for us to buy this market. So if we drop to the daily time frame, the market is seeking something. We've already mapped out what the market might probably be seeking in this weekly time frame. To me, I already know. So I've dropped to the daily time frame. So every drop as the market is going down here, I can say, okay, this is just the market pulling back, as in pull back of the market to be able to give a reason to buy. The market has dropped. Some people might see it as a fall. But then if we drop to the lower time frame, let's drop to a lower time frame, one hedge, and watch this area. So we are looking at where would the market possibly get to give us an entry. At the same level, you can see how huge this place is. So this is us on the same level that we've mapped out on the lower time frame, probably the one hedge as our place of entry. We are looking for where the higher time frame and the lower time frame agrees together in the direction that the higher time frame has suggests. So we can see how the market dropped to this level. Watch this level. It got to this level. I've already noticed that the market might apparently reverse at this level. Let's assume you took this trade here. Yes, this would have come down to take you out if your stop loss is close. I'm not disagreeing with that, but we have a more higher probability to say that, okay, the weekly says bullish, the daily says bullish, the 4H says bullish. Now our 15-minute time frame and 1H is what we are waiting for. When is it also saying bullish? We are looking for that to also change to the direction of the higher time frame. At this point, we can see the market dropped, get down a little bit, take out liquidity, broke out structure. Here we can apparently say, okay, the market has changed back to bullish structure. Just using maybe like break of structure here, that will also teach at some point in time. You can see, watch that level, the market got back and took you out. That's fine. So, but we are kind of more on the high probability of buying. Let's go again. The market also get to that level and broker structure again has also changed in the direction of the weekly, the daily, the 4H, the 1H. So now everything has agreed together. Can you see? This gives us what? A more high probability. The probability of success increases as we follow this pattern or this structure that the market, all of them has flowed in the same direction of the higher time frame. Notice I said not certainty, I said probability because trading is, like we said, the market has given us a higher probability of buying because it has agreed with a higher time frame. The higher time frame has said buy, the daily has said buy. So when we drop on the lower time frame, we are looking at the reason or when the market has agreed to buying in line with what we are looking for. Remember, we said probability, not certainty. So trading, like we say, is also about probability. But when the market is in disagreement, like if the higher time frame says we are buying and the lower time frame says sell, as you can see, market dropped here. The market is not agreeing. What do you do? So you have to do what? Remain patient to that. The wait for the lower time frame to align with the higher time frame before entry. This is why patience always pay. You have to wait when they are not in line, in sync with the professionals, in sync with what? The higher time frame. The professionals always remain patient to their trading. There's no need to hurry and get your stop loss hits. So this is the reason you have to wait when the higher time frame and the lower time frame are not in sync together. Remember, we said that the higher time frame is giving us direction, the lower time frame is helping us to do the execution in the market. So that is exactly how to do this. When they agree together, that is when you'll be able to take a trade. Let's take this exercise. One of the things you need to do is go through your charts, pick any chart of your choice, any pair of your choice, open your chart, start with the weekly, just like we did. Go through the chart and start with the weekly time frame. Go to the weekly um, charts or any one you pick. Write one sentence. Is the market bearish? Is it bullish? Is it ranging? Look at the market very well. It will tell you exactly what it's doing. Write a sentence. If it's bullish, if it's bearish, if it's ranging. Also, move to your daily charts. Also, do the same thing. Is the market bullish? Is it bearish? Is it ranging? Do the same in 4H. Do the same in the 15-minute time frame. Then ask yourself this question. Do all these charts tell the same story? Are they telling the same story? If not, wait. If yes, you might have a trading opportunity. That's just the way it works. If they said no, they are not the same, they are not telling the same story, that means, okay, wait. If they said, okay, yes, so look carefully, you might have gotten a trading opportunity for yourself. These things will begin to help you to see the market much more clearer than just trading what you think that the market is doing. So we said again that the higher time frame provides what? Direction. The lower time frame provides entry. So the weekly and the daily time frame charts, they build the narrative you are looking for. Yes, the lower time frame reframes or refine the execution. Never ever allow a lower time frame, your 1 minute or 5 minute time frame chart, to change your opinion of what the daily chart is clearly telling. I don't know if you get me. Do not allow your lower time frame, be 1 minute, 5 minute, 15-minute time frame, to change your opinion if the daily chart is clearly telling another story to you. Professional traders trade with the current. Retails often fight it. So don't do that. Remember this. The higher time frame is always the captain, is in charge of your trading, while the lower time frame is like the one that navigates for you to get to where the higher time frame has suggests for you to get to. The homework. What you should do, that's just like that's the like an exercise for you to just look at. So the homework, what you're going to do now before our next class, choose any forex pair of your choice. It can be Nasdaq if you want to, then complete this exercise. Let's do it together. That's the way to learn. I'm just helping us to learn. So identify the weekly bias. That's number one. Then identify the daily bias. That's number two. Then mark your nearest buy side and sell side liquidity, which we've also talked in. That's why we said everything put together will help you mark them. So write just a sentence, write one sentence of the market narrative. Check whether the 15-minute time frame chart aligns with your higher time frame bias. Don't take any trade, please. Just check if they align together. Just observe. Your goal this week is not to make money. Your goal is to learn to read the market story very well. So when you learn all these things and put them together, you begin to see clearly and they will help you. Right? You might think that we are doing nothing on this we are doing, but no. If you can practice those things we are saying, go through them, and you begin to see the chart differently, you begin to understand better how to put this thing together, and they will help you in your what? In your trading. So this is what you should do. My final thought: do not ask the questions where to interface, but ask what's the weekly story is all about. What's the daily story? Where is the liquidity? Is my lower time frame confirming the higher time frame bias? That is how institutions work, and that's how we think also here in liquidity narrative class. We don't chase the candles, we don't follow personal opinions. It's all about mapping liquidity first and then following structure over speculation. Till then, I will see you in the next topic. Be safe and thank you.